Okay, so we're going to take a look at 2011 question 8, marginal costing, and the first thing it asks you to do in the question here is to set out the company's break-even point and margin of safety. So in order to get those, we need to do the marginal costing statement first of all. So we'll start off with our part A, and the first thing we want there are the sales, and we know that there was 90,000 units. Now the figure is given for the sales at 1,170,000. So we have that, and I'm just leaving some space here because we'll do a per unit column as well. So per unit, the sale price was 13. So that's simply 1,170,000 divided by 90 gave me the 13. And then we set out our variable costs. So they're literally listed there. The direct materials, at 390,000. We have our direct wages, and they were 236,000. And we have our factory overheads, now factory overheads are listed at 82,000, and we were told that the materials, direct labour and 40% of factory overheads are variable, so we just want 40% of the 82. So that works out at 32,800. And you can just run that up in your calculator. And the selling expenses, are 105. But you were told that apart from sales commission 5% and sales, selling and administration expenses are fixed. So it's just the sales commission part at 5% on sales that we want to get for here. So so 5% of our sales, and that works out then at our 58,500. So those are our variable costs, and we can subtotal those. Then we have 717,300 in total. So subtracting those then will give us our contribution. And again, we can get a per unit on each of those. On the variable costs, if we're dividing by 90,000, the variable costs work out at 797 per unit, and the contribution per unit, 452,700 divided by 90 works out at 503. We should tally anyway. So that gives you then the contribution. So less the fixed costs is next. So our fixed costs then, we know, are the remainder of the overheads. So it's the 60% of the 82,000. That's balance figures, so you don't need to write it up, but just to show you where the figure's coming from. So that's 49,200. And we also have the selling and distribution. And remember, we have already accounted for the sales commission of 58,500. So if we take our selling expenses of 105, and if we take out then our sales commission of 58,500. Then our selling expense is 46,500. And finally then we have our admin expenses. And the admin expenses are listed at 130,000, so we can simply slot those in. So fixed costs then coming to 225,700, and that leaves us then, we subtract that again, we'll have our net profit at 227,000. So that's our net profit. So once you have your marginal cost statement done to net profit, then you do your break-even point, and that's equal to your fixed costs over the contribution per unit. So our fixed costs here were 225,700, and we're dividing by the contribution per unit. So our contribution is here, per unit is 5.03. So dividing that in, it tells us we have 44,871 units to produce in order to break even. The margin of safety then is your total budgeted sales minus your break even. So we're budgeting on selling 90,000 units. Our break even in units is 44,871. So the difference between the two of those is our margin of safety. So 45,129 units is our margin of safety there. Okay, so now we're going to look at part B of our question, which asks us to find the number of units that must be sold in 2011 if the company is to increase its net profit by 20% over the 2010 figure, assuming the selling price and cost levels and percentages remain unchanged. So the So we're looking for the number of units we need to sell to increase the profits by 20%. Well, the formula for that then is your fixed costs plus your target profit divided by the contribution per unit. So what we want to do there first of all is get this targeted profit. So our profit then for 2010 profit, we just calculated it there in part A at 227,000, and we're looking to increase that by 20%. So 20% of that is 45,400, so just run that up in your calculator. So in other words, our target then would be those two together, 272,400. So that's our targeted profit. So now we can fill in our formula, our fixed costs that we had in part A, 225,700 I should say, plus our target profit of 272,400 over the contribution per unit, and we had calculated that at 5.03. So if we run that figure, it tells us then that we must produce 99,026 units to increase our profit by 20%. Okay, so for part C, we're asked to find the profit the company would make in 2011 if it reduces its selling price to 11, increases the fixed costs by 15, and thereby increases the number of units sold to 110, with all other cost levels and percentages remaining unchanged. So what we need to do there is restate the marginal costing statement given these new parameters. So sales are going to be equal to 110,000 units by the new selling price of 11. So that works out at 1,210,000 in sales. Now the variable costs will change because the commission on our new sales figure will change. So I need to recalculate that variable cost per unit. So if I just take a piece here on workings, so our variable costs are made up of our materials 390,000, we have our labour at 236,000, so they're not changing, and we have the factory overheads 40%, and that was 32,800. We had that already in part A, so nothing has changed there. So the constant part of our variable overheads is 658,800, and that then works out at per unit 732. So the unchanging or the constant part of our variable costs per unit works out at 732 per unit, so that's not changing. But our commission then is changing, so our commission is now based on 11 euros per unit, and we have 5% of that, so our commission is changing to 55 cents. So in other words, our variable cost per unit, our total variable cost per unit is 787. So variable costs at 787 for 110,000 units works out at 865,700. So sales minus our variable costs give us the total contribution and then minus your fixed costs, and we're told that the fixed costs are what was there already, 225,700 plus another 15,000. So our fixed costs then totaling at 240,700. So when I take that out, then I get my new profit figure of 103,600. Okay, so for part D, the question is asking us to find the selling price the company must charge per unit if a fixed costs increase by 12% but the volume of sales and profit remain the same. So part D, all our workings really are dependent on the margin costing statement, which says that sales minus variable costs minus your fixed costs equals profit. So here I'm just going to restate that so that the unknown entities are on the one side and the known on the other. So our sales are going to change. We have to find the selling price, so we don't know what our sales figure is just yet. And that means then that our commission is also going to change. So that piece of commission that's a variable cost will be an unknown entity. So I'm going to leave that on the left. However, the fixed costs I'm going to move over the equal sign up so it becomes a plus. So our fixed costs are are known because it says that the sales and the fixed costs will increase by 12%, so we can calculate that, and the profit is going to remain the same. So the fixed costs plus the profit on the other side. So I'm going to fill in what I know then on that statement. So I have 90,000 in sales. Okay, so the quantity isn't changing, it's just the selling price. So I'm just going to put in there an S for the selling price. So 90,000 by S is our sales, minus, and again we have 90,000 in quantity. And we know that from part C that the constant part of our variable costs was 7.32. We calculated that earlier. And that's going to remain the same. It's just the commission that's changing, and all we know about the commission that it's 0.05 of that selling price. Okay, so that's our formula for the variable costs, and that's equal to the fixed costs of, and again just to check your question, the fixed costs are increasing by 12%, and the fixed costs were 225,700, and we're increasing those by 12%. So we're going to add on our 12% there, and our profit figure. And our profit figure we had earlier in part A, and that was 227,000. So you fill in what you know there. So if I multiply that out, 90,000 by the selling price remains the same. 90,000 by 7.32 becomes 658,800, and 90,000 by 0.05 is 4,500 by S, the selling price. So the opposite side then, adding on my 12% of 252,784 plus the profit. So again, just narrowing it down, 90,000 by the selling price, and multiplying in the minus sign there to that bracket, I have minus 4,500 by the selling price. And I'm bringing across this minus over to the opposite side, and it becomes a plus. So I'm adding it on to these other figures here, so I've consolidated those. So you keep going then until you can solve for S, and it works out at 85,500. S equals 1,138,584. And that means then that S is equal to the divide of that, and that works out at 13.3167. You can round that then to 13.32 as our selling price. So now we're going to go at part E, and we're asked for the number of units that must be sold at €16 per unit to provide a profit of 10% of the sales revenue received from these same units. So here we're going to use the same formula again, but just to rewrite it this time with the number of units as the unknown, and also because our selling price is moving to 16, it means that our commission is changing again, so therefore the variable cost part is changing. So we need to work that out as well, the variable cost per unit. So I'm going to start with that, the variable cost per unit. So again, it hasn't changed in that we've 390,000 in our costs, which were our direct materials, and we had wages of 236,000, and we had 32,800 as the factory overheads, that was 40%. Now really we've that done before, but just to show you where the figure is coming from, so that totaled at 658,800, and per unit then that worked out at 732. We've had that before, we had it up here, and now we have to add on to that for our variable costs. We have to include our commission. So our commission is now based on 16 euros by 5%, and that works out at 0.8. So you get that in your calculator. So if I add in the 0.8 and that, I have 7.32 plus the 0.8. It means that my variable cost per unit is now 812. Okay. So variable cost per unit there. So now I'm going to take my marginal costing statement, that formula there. And I'm going to fill in then what I know. So on the sales side, I know that I am selling at 16 euros per unit, but I just don't know the number of units. On the variable costs, I know that it is 8.12 per unit, and again I don't know the number of units. And on the fixed costs, I'm going to bring the fixed costs over to the other side because I do know that figure. My fixed costs are not changing, and that's 225,700. And that is, bringing the minus over becomes a plus, and I'm going to add that onto the profit figure. And the profit, we're told, is 10%. So 10% of 16 is 1.6. And again, we don't know the number of units, so that's 1.6 n there. So if I rewrite that with all the n's on one side and the known entities on the other, I'd have 16 n minus 8.12 n minus 1.6 n equals 225,700. And again, you just total that then at 628 n equals 225,700, and you don't even need to write all this out, you'd have it done in your calculator then at this point. N is equal to 35939.49. So the number of units that I need to sell can be rounded to 35940. Okay. Now for part E, you could also use the formula, which is so this is an alternative. It's a formula where you have fixed costs over your contribution per unit minus the percentage profit of your selling price. So in other words, your 225,700 over the contribution per unit, so that would be your sale price of 16 minus the 8.12 that we had to calculate up here. So either way, you have to calculate this new variable cost per unit, and that's going to be minus your 10% of 16. Your profit, in other words. So that works out then at 225,700 all over 6.28, and it gives you back the same figure, 359.49, which runs 35940. So either way, you get the same figure. So part F then is a little bit of theory. First of all, it asks us to list and explain two limitations or assumptions of marginal costing. So first of all, if you focus on variable costs, it's assumed that they are completely variable at all levels of output. However, sometimes there are economies of scale and variable costs may decrease. And point number two, if you focus on fixed costs there, again, fixed means that we assume they're remaining the same, but most of them are only fixed within relevant ranges of production. So really they're what's called step fixed. So part two then of F asks us to roughly sketch a graph of step fixed costs using the following rental payments, and very straightforward. Simply put your euro values on the y-axis and your outputs on the x-axis, and again just mark out your key markers. So we have 5,000, 12,000, 19,000, 28,000, and output levels are 20, 30, 40, 50. So just starting at 0, 10, 20, 30, 40, 50, 60. So my first marker then is on 20,000 units is at 5,000 in rent, and I stay at that until I get to 30,000 units, and at 30,000 units then my rent jumps to 12,000, and it stays there until I get to 40,000 in output, and then I jump to 19,000 in rent, and so on. So I just marked out the key points and then really just join the dots, and it comes out in a step format. Okay.